Welcome to our weekly Forex and Gold forecast. My name is Jay, and I'm a trading instructor at Trading University. As always, we need to remind you trading involves risk of loss and is not suitable for everybody. First market we're taking a look at is the Australian dollar. AUD had a bit of a correction, a pullback in sympathy with weakness in the euro. Here's what I would caution Aussie shorts with. You never took out that May low, which pretty much early May, it's gonna it's kind of a proxy for the April low also. So you have a double bottom here. You have the April low and the May low, and now you're there again. So you have a triple bottom there. Keep an eye on this level. However, you get a couple daily closes, and I think that'll flush longs out of there pretty good. That'll embolden shorts in this market also. So kind of hard to get too excited about the short side because you're in the hole. Basically, you're right on top of a triple bottom. You're at a 2-month low. You're right on support. So keep that in mind. Now, again, a couple closes below it, that can change that picture in a hurry. But from our perspective, this is still an uptrend. You still have a pattern of higher highs. Even here, that's still a slightly higher high. Next market would be the chief, the dollar Swissy. You can see this market's getting comfortable above that 50% retracement. You take that high, that's the 2014 high to the 2014 low. You're getting comfortable above 50% retracement. That means the odds get better and better that you'll see 90 even, that you'll extend that beyond the 618. You'll get up towards what WD Gann used to call the top of the pipe. So I think you got a good shot at the top of the pipe. A lot of it depends on the euro, and we're going to cover the euro shortly. Euro at a crossroads for sure, at an interesting place. First, we're going to look at the dollar index. Dollar index is pretty cool. You can see that long-term trend line. However, trend lines are neat, but they're just linear indications. I prefer non-linear indications, and probably the best indication I like, keep it as simple as you can. That's a series of higher lows still. So yeah, you clawed above a trend line. You had a good close on a Friday, good strong close on a Friday. You probably ran out any individuals that tried to short that rally. You put in a higher high too, which is significant short term. You guys who follow us at Trading U, you've seen this chart before. No matter how you slice it, this is a bullish chart. Look at, you have a nice big rally, that the 2011-2012 rally, and then basically you went sideways. You're still in a sideways market. Essentially, you're consolidating those 2011-2012 gains, and you're consistently finding support on the 50% level. A breakout here could be big. It really could be big. A lot of big name traders anticipating that. We anticipate that at Trading University also. I mean, we're definitely, you drop back down to the daily chart, we're in the buy the dip mode. I prefer to buy dips rather than breakouts, which kind of spells where I'm at right now in this market. We're still bulled up on it short term. That's what I love about being a short term trader. I could pop down to a short term chart and I can just start buying dips down there on those lower time frames, and that's what most professional traders do. 90% of financial futures volume is day traders. In other words, 90% of your professionals trade those intraday charts. Next market we're going to take a look at is the euro, and here's the big picture too, and that crossroads I was talking about. It's a pretty cool chart here. This is a significant level. We talked about it, we've been talking about for a couple weeks that the market's probably headed there, and not only headed there, it closed below it, really didn't provide any support. That green line, the April low is pretty significant too. It's always significant if you can close below it on a monthly basis. We'll see where we're at come next week on the last day of the month. If you close below that, that'll be significant. But it's support, and it's easy to get all bared up. It's really it's easy to get excited if you want to see lower prices because you close below it. But I have to caution you only close below it once. Here we see very similar levels back here in November of the previous year. You got down to a very similar support. This, by the way, is a secondary support level. That's pretty long term. And there's you have primary resistance here, and then you have secondary support. You have primary resistance here, and now this is going to be secondary support. You had secondary support hold at the tail end of 2013. You had it hold again here in February. This is kind of what it reminds me of. Look at February. You closed on a Friday, last day of January into February. You closed below it one day. You didn't get the second day. Market had a chance to firm up, and then they were able to throw the shorts out of there. Now we're here again. We got a Friday close above a significant level. Now, this is going to be significant if you close above it the following day. So that's what I'm looking for. That's what a professional is going to be looking for. If you get that second close below support, and then if you do, you're going to be much more aggressive intraday selling rallies. You're going to be selling short-term rallies a little bit more aggressively after you get that second close below there. So that's definitely a level to watch. Big picture, the big picture is bullish in the U.S. dollar, as I said. So, equally bearish here. To me, this is a bearish indication. There's that 6-month secondary pattern. We're waiting for it to give out. We can't declare that 6-month secondary pattern bearish yet until you close one more time below that low on a daily basis. So overall, you still have a pattern of higher highs and higher lows. However, if you close below that again, that's going to be significant. Again, what that'll do is a green light. Short-term traders, they'll be more aggressive. That short-term selling, of course, can have a tendency to have a spillover effect and start knocking out longer-term traders, drawing in longer-term traders to work that short side also. So that's what we're looking at. Pretty significant level here at 136.50 or so. So you get the second daily close below there. That's a bearish development for sure. Last market, gold. Next market, gold. We've been talking about gold for a while. This looks like accumulation. Dangerous market. As I said last week, it's a commodity. Commodities are wild cards. I don't really, a lot of people say it's an investment grade market. On the other hand, it doesn't have a yield, and there's no dividend to it, and you're getting ownership of something that you have to pay to store. So tricky market. Here's what kind of scares me about the gold. Okay, yeah, support has to hold here. It kind of reminds, this smaller term pattern kind of reminds me of this longer term pattern on the weekly chart. Let me show you something. Here, this is a big pattern. You had the 1, 2, 3. You had a triple bottom hold initially, but then look at that. The triple bottom died out somewhere just beyond a 625 retracement. So that was a bullish development, the triple bottom, but bearish development. You couldn't mount a serious rally off of there. You ended up with a lower high. Similar here, you look at that big pattern on the weekly. Now I'm looking at the daily pattern. And look at that. You can't get up and go. The market's got to get up and go. It's got to take out, it's got to first take out this high, then maybe that high. Then once you have higher highs, you're going to attract traders to buying dips. Right now, you're not buying a dip because guess what? Buying dips is not working. Well, it worked here. It didn't work so well here. Not so well here. It's really not working so far. So you probably have a lot of longs in here. And here's my concern about gold. You know what I'm concerned about gold? Because I'm concerned about silver. Let me show you silver. And remember that 3 pattern that gave way in the gold last year? Look at that. 1, 2, 3. This market, you're seeing progressively smaller rallies here. That's not a healthy development, okay? So I'm concerned that, well, I know there's a lot of bulls in here. There's a lot of traders that are accumulating silver at these levels. And why? Because they're counting on $30 or if they'd kill for 25, honestly. But, it was just a couple of months ago, 30 was the target. Before that, it was back to 40. So their upside targets are getting lower and lower because the market's not going anywhere. This market is ripe for a raid here. This is ripe for a raid. I don't like gold because I don't like silver. If it's going to go, it better go soon, right? So if you were to see a serious sell-off in the euro dollar strength, if you see dollar strength, it's going to be awful tough for the metals to rally. If the metals don't rally, guess what's going to happen? They're going to get weighed down because you have that carry, okay? They don't earn an interest. If you have something, if you're hanging on to something, you want to earn interest, you want to get a dividend. If you're hanging on to something, you have to pay to hang on to it, it's going to get heavier and heavier on you. My point being, gold's heavy because silver's heavy. Last market we're going to cover is the dollar yen. There's the weekly pic. There's the weekly picture. I suppose if I show that weekly picture, I got to really show you the big picture here. I still think there's probably some upside here. Let me look at the daily chart, and this pattern you're in here, this wedge, reminds me of this wedge. You may not get as big a rally here as you got here, but if I'm a gambling man, I'm thinking you're going to rally out of that wedge, and we'll have to see. So to me, it looks like dollar strength going forward. But here, let me remind you. This is a big piece of the puzzle. You're not going to get dollar strength until you get a second close below this significant level right there. See how they sprung the trap at the last day of January, early in the year? You got to watch that. On the other hand, you get a second close below there. That's going to embolden your shorter term bears. So that's what we're looking at Trading University. Hey, thank you so much. We look forward to seeing our students in class on Tuesday for the live class, and we look forward to seeing you all again on YouTube in another week or so. Thank you so much, and I'll leave you with one of my favorite quotes from my mentor, Bill Williams. Trying to change your trading without first changing your mindset is like trying to convince yourself that a merry-go-round has a destination. That's right. What you think before you sit down in front of the computer has a lot to do with how you're going to do as a trader. Thank you so much, and we'll see you next time.